So we've done some very simplistic forecasting where we just took NOPAT as a percent of sales, we took operating assets percent of sales, and we kind of went with it. Well, here we're going to go down more into the line items of the balance sheet and income statement. So we're going to be forecasting what's going to happen to the business. We call these operating items. Then we're going to do a preliminary financial policy, which means what happens if we need money. And the simple one there is we draw down on a line of credit. Magically, we have all the money we need from the bank. All we have to do is ask. So that's our first pass on this. Then we're going to see, given all those moves, is there going to be a surplus or deficit in cash? In other words, do we have to draw down on a line of credit, or are we generating excess funds? And finally, we keep iterating on these assumptions and honing our assumptions until we have an achievable and the best possible outcome. First, we're going to be setting up our forecast. We lay out the past years, and everything really is driven by sales. That's true in general, and you'll see it here. So let's start with forecasting sales. Then we'll forecast the other elements of the balance sheet and income statement based on sales. And here we're looking at the details of cash, AR, inventories, fixed assets, and our costs. Then we'll forecast depreciation based on percent of fixed assets, because we shouldn't grow depreciation based on sales alone. So those are our initial assumptions. We'll call that the no changes scenario, where we're not messing with any of the underlying ratios. The only thing we're doing is changing sales. Then we'll look at what impact it has on our cash flow and whether we need money or not. The key assumption, as we mentioned about, is sales. And here, the sales assumption is that we will grow by 10, 8, 5, and 5 over the next 4 years. And the target weighted average cost of capital is 9%. We will need that for the valuation when we discount the future cash flows by 1 plus WACC to the power of the number of years. All right, so I'm going to hop out into Excel. I've just copied the picture here, but it's much more valuable to look at the Excel sheet. So our steps, just before we jump in, is we're going to look at actuals for 2016, make some key assumptions about the growth rate in sales, then also make some other assumptions about how the other elements of the balance sheet will change. And we'll do this now in more detail. All right, this is the spreadsheet in Excel, and you'll see the tab Projections First Pass. And first pass in this exercise means don't change very many of the relationships. Let's just make the change to sales and see what happens. So that's what we're going to do. We're going to start with 2016. These numbers were what we saw on the previous slide. We're then going to lay down a base year of 2016, look at what growth occurred in sales, and then the relationship between sales and the key line items, those being operation cost, the cash, AR, inventory, fixed assets, and AP. Those are all going to be used in our projections of the balance sheet. The only one that's not tied to sales is the depreciation. We're stating that as a percent of fixed assets. So here's 10% of fixed assets. Tax rate is just an assumed 40%. All right? So then we look at assumptions. These are the assumptions, and I'll put this in, let's say, green. This is the key thing we're moving in this scenario. We're going 10, 10, 8, 5, 5, which we've seen previously on the slide about our projections. But all these other ones, from the operating costs as percent of sales all the way down to the AP percent, remain the same for 2017 as it was in 2016. That's why we're calling it status quo. Now we're ready to do the projections. Here's 2016. That's just the baseline. Then we start our projections. This cell is the last year, the year 2000, times 1 plus the growth rate for 2017. That's 10%. Next is the same. It's just 2017 times 1 plus the growth rate projected for 2018. All the way to the last year, where we say 2020 equals 2019 times 1 plus the growth rate. So you see how it is. Just make sure your formulas have the right factors in them as far as relative and absolute. Now we look at operating costs. This is a pretty easy one. We say, what is it? Is 90% of the sales. And that is just copied straight across the last year is again 90% of sales. The depreciation we'll do later because it's different. EBIT is a subtotal. We'll do that later. And let's move down to cash. All right, so cash for 2017 is cash as a percent of sales times sales. And we replicate that across. And you see it here in year 2020. Same thing with AR. AR strictly as a percent of sales. Here's 14% of sales. Inventory as a percent of sales, 20% of sales. Fixed assets, we state that as a percent of sales, which is 2,200 times 25%. And AP, we're going to use this for our growth in spontaneous liabilities, and that's 4%. Then we just copy this block over to this area, and we're done. Then we go back up to depreciation. Now we're good because depreciation equals 10% of fixed assets. That's why we picked up later. And we copy that across to the 4 years. Now we're ready for subtotals. Subtotals, EBIT equals revenue minus operating costs minus depreciation. And then income tax. Income tax is equal to the 40% times the EBIT, and we end up with no PAT. Now notice we did not end up with net income. Later on, we're going to deal with interest expense, right? And NOPAT does not include the effect of interest. And NOPAT is simply the EBIT minus the taxes, and then we'll replicate that across. So this spreadsheet should seem pretty familiar to you because we're doing projections based on relationships on sales, and we're just copying them across. So now we finished our forecasting of key accounts.